Thanks, Masaki. So good afternoon, everyone. Thanks for joining the session today. It's good to see a reasonable turnout. So my name is Nikki Cornwell and I'm a manager in the risk advisory practice at KPMG Australia, and I specialise in operational risk analytics. So the presentation that I'll be doing today is some research from my PhD conducted at Bond University, which was partnered with KPMG. And I'd like to acknowledge the contributions of my co-authors from the Centre for Data Analytics at Bond, and also some researchers from Bangor University in Wales. So, let's see if the technology's going to work. Is this on? There we go. So to start off, let's start with operational risk and operational risk management as we know it. So that we're all clear on what we mean by operational risk, let's refer to the generally accepted definition, which is from the International Basel Accords around their operational risk capital adequacy requirements, and that is the risk of loss resulting from inadequate or failed internal processes, people, or systems, or from external events. So while this particular definition is in the context of the banking industry, non-financial risks or operational risks are inherent throughout all organisations and across all sectors, and the work today that I'll be presenting is cross-sector. So what can be the consequences of these risks? Well, of course, we can get costly losses and incidents arising. So they might result in financial loss, be it direct or indirect. And some statistics here from the OpRisk Data Exchange that on average per year from the global banking industry, we've seen 35.5 billion Australian dollars of losses. And if we look back to December last year alone, Wells Fargo reported a loss associated with unlawful activity across multiple product lines, which impacted 16 million companies, and that led to fines and remediation in the realm of 3.9 billion US dollars. So back in the Australian dollars context, that's close to $16 billion of losses from one type of incident, essentially. And we saw similar violations in the Australian Royal Commission in banking in 2018, of which those incidents are still being remedied today in some cases. And of course, we've got catastrophic situations of lives being lost as well. So in the case of coming out of Safe Work Australia, they report an average of 179 people's lives lost from preventable work-related activities on average each year. So what are we trying to do to avoid these bad outcomes? Well, of course, we have operational risk management. And in Australia, over the past decade, globally, this has been gaining more and more attention, particularly in Australia at the moment, with the release of CPS 230, which is a dedicated prudential standard for operational risk management in the banking industry, which has been released by APRA, our prudential regulator. This is becoming a very topical topic recently. So we've got ORM, or operational risk management, or we could even broaden it out to ERM, enterprise risk management, where we have the ERM lifecycle, which is then underpinned by a series of tools or methodologies to help with the assessment and monitoring. So we see things like risk and control self-assessments, which happen generally once a year in organisations. We use things like likelihood-severity risk matrices, which lead to bucketed risk ratings. We have audits and controls testing. And these existing tools are really quite qualitative in nature and rely heavily on the manual inputs and analysis from people. Which brings about three key challenges. So quite simply, we're getting infrequent and static snapshots of the operational risk profile of organisations. Secondly, a lot of these assessments have the potential to be influenced by the subjective biases, tolerances, perceptions of the individuals who are conducting those assessments. And thirdly, they're inherently backward-looking. And in some cases, there's some regulation, for example, if we even think about capital requirements, which are kind of unintentionally driving this reactive behaviour to op risk management. So not only are the processes themselves extremely costly and inefficient to perform, but if the consequences of performing these assessments are leading us to mismanaged or ineffectively managed risks, we can then get back to the extremely costly outcomes which we've already spoken about. So quite simply, to summarise all of that, there is an opportunity and a need for improvement on how we currently do op risk management. And this is quite a growing area of research and practice, and we're seeing more and more in this space on how we can improve and modernise ORM by using data analytics. So this diagram here on the slide depicts the general concept behind this area of research, that being that we have a series of different data inputs. They could be incident and risk information, internal operational data, or potentially even tapping into external data sources. We input those into a variety of different probabilistic, statistical, or machine learning models to then hopefully uncover some valuable insights that can help us be more proactive and targeted in our mitigation and risk decision-making process. Bottom line of it, try and reduce the frequency and severity of those costly incidents that we've mentioned. And there's a great realm of possibility of using different pieces of data together, using different types of techniques to try and solve and answer questions about different parts of the ORM lifecycle. And so to support operationalising this somewhat high-level concept, actually in practice in organisations, my team and I have set out a framework for data-driven ORM, which you can see here. So this leverages principles from the actuarial control cycle, which we'd all be very familiar with, and also the IPO model from information systems theories around inputs, processing and outputs, and it culminates in four main components: the inputs, the modelling, the implementation and the recalibration. So in terms of inputs, we can consider a variety of different types of data inputs, spanning risk and historical incident data, control and mitigation information or remediation information, as well as the operational data feeds that exist in day-to-day business activities. And supplementary to that, any sort of predefined design or procedural information. So if you're thinking potentially in a mining context, for example, that could be information from owner equipment manuals about tolerances that machinery should be operating within. And of course, we also need to consider the compute facilities to be able to make all of this happen. Second, we have the modelling component. So this can consist of various modelling modules, and there's a vast number of possibilities here. So the 5 that you can see up on the screen have been drawn from an extensive cross-sector literature review on the applications of data analytics to ORM. And so we found here key use cases were around the identification of risk using things like natural language processing and clustering techniques. Secondly, around analysing the factors that are likely to exacerbate or influence risks, and we'll dive deeper into this one in a moment. Third, around quantifying the risk and calculating capital, which historically actuaries have had a big focus on, using techniques such as the loss distribution approach, mostly here. Fourthly, around predicting information about risk, so that could be anything from what type of risk is likely to occur or when. And here we often are seeing different machine learning techniques, particularly SVMs, being quite prominent. And then, of course, we can move into more prescriptive analytics as well. So some work's been using reinforcement learning to recommend the optimal action or decision to take given a set of circumstances and what we're likely to see in the future using some risk-based optimisation function. Moving on to the third component, implementation. So once we have the model and the outputs from the model, they need to be interpreted. And then from those insights, we need to derive actions that then, of course, need to be acted on to actually initiate any meaningful change that we're hoping to get out of this approach. So here, this taps into another huge area of research around behavioural change, which Jackie in this morning's panel session touched on as well. So thinking about how do we communicate those actions to people in the organisation. Is it machine to human? Is it human to human? What's the optimal combination of these things? And integrating them more broadly with other digital risk management tools in an organisation. And then, of course, we need continual monitoring over the impact of that implementation compared to what we expected, coming back to the actuarial control cycle. And then the final component, recalibration, which underpins all of those components. So there's a need to both reparameterise the model with new data streams as it's coming in, but also looking out for structural changes which may be having an impact. So new data streams, new risks that may initiate a bigger recalibration. So let's now dive into how we could actually apply the model. So in this case, we're going to touch on sort of the causal factors or root cause analysis application. And here we're mainly tapping into the operational and risk or incident data sets. And so you might ask, what's the rationale behind choosing those two out of the 5 that I've got up there? Well, if we think about operational incidents at their core, they're really arising from issues in our day-to-day business activities. So it could be the characteristics of customers, it could be how those customers are being serviced, it could be the systems and processes behind that. And so these are essentially the precursors to incidents. And in today's digital operating environments, organisations are essentially automatically capturing those day-to-day business operations in electronic systems as it is currently. And so we can then say that in many cases, we actually have existing data streams of those potential precursors to incidents. So why don't we tap into that operational information and couple it with our incident and risk information to understand what are the conditions or the causal factors that could be influencing our operational risks. And then, of course, the next step is to quantify the effect of each of those drivers, or potentially even the collection of drivers, and produce objective measures to not only identify which levers we can pull, but actually which levers should we be pulling to have the greatest effect, given that we have limited resources. So coming back to that triaging of mitigation strategies. And they could look, those mitigation strategies could look anything from strategically designing controls, having targeted audits and investigations, or having specifically designed KRIs for our frontline staff to ensure that different operating factors are operating within those acceptable thresholds in the broader system. So from this hypothesis, my team and I have built and tested this approach to data-driven causal factors analysis in an insurance company. And conscious of time, I'll quickly run through this. So here we looked at incidents of non-compliance by advisors in the insurance company's call centre. So looking at things about whether the advisor's providing incorrect product information to their customers, other issues around failing to follow legislative requirements. So we augmented historical incident data together with data coming out of HR and their call management systems, which included operational factors about the characteristics of the advisors and also different call types. And so from this data, we trained a model to capture how these operational factors, so they're the grey oval nodes, which hopefully you can see on the screen, it may be slightly small and blurry, apologies, and the incidents, which are the coloured rectangle nodes. So when we looked into this, the relationships that were captured by the modelling approach were reasonable and broadly consistent with with the discussions from the experts in the insurance company. However, it was driven by the data itself. So as an example, we can see department has a really broad influence across the incidents that we were considering. And from that, we can start to understand, well, if we work higher up in the tree to mitigate and control those components, it's going to have a funnel down effect to the incidents lower in the tree. And we also identified the notion of risk co-occurrence. And when you extend this to incorporate a temporal element, that then becomes the concept of risk contagion. And so here we can see the blue incident, which was categorised as failing to follow other legislative requirements, also influenced the probability of an advisor providing incorrect product information, as well as not following call scripting requirements. And so by focusing mitigation on those parent incidents, we can indirectly reduce the risk of these other two incidents occurring. Similarly, knowledge of a parent incident occurring could suggest we could provide just-in-time intervention to some other types of incidents, or targeted auditing processes to make that auditing more efficient. And then, of course, we can run sensitivity analysis over different nodes in the tree. Given that it's all interconnected, we can see the different risk profiles for different types of incidents with respect to different factors. So in this example, we're looking at the tenure of an advisor. And we can see that there's a heightened risk later in the tenure for advisors around providing incorrect product information, as compared to the other two types of incidents considered here, that there was a higher risk earlier in an advisor's tenure around the failing to follow legislative requirements. So that then goes to potentially changing our controls or designing our controls in a more targeted way, fitting, for example, changing when we're doing training on certain types of information that the advisors need to be aware of. So this was an example in the insurance context. We've also applied similar logic in the aviation safety area, and are also currently working on some work in rail safety. So it's really industry agnostic, this general approach. So as we can see from this application from the causal factors module in the data-driven ORM framework, but more broadly by taking a data-driven ORM approach, we can gain some of the much-needed improvements over the traditional qualitative and manual ORM processes and tools. So to run through these quickly, firstly around providing more clarity. So combining multiple sources of data which maybe we haven't combined previously can help drive more scientific and population-based assessment and inference. Secondly, greater consistency. So where a model, as we know, is reproducible in many cases. Unlike the mental models of humans who may be assessing, and of course those humans are then coming and going from organisations, which creates inconsistency in how risks are assessed over time. Ultimately, we can achieve continuous monitoring rather than simply getting those static snapshots. And the real aim here is to empower organisations to have greater confidence in what their risk profiles are looking like in the future, to provide more proactive mitigation and that forward-looking approach to risk decision making. So thank you for your attention this afternoon. Welcome any questions and feel free to chat after the session today. Look forward to meeting you all throughout the conference, and my contact details are up on the screen if you want to talk further. Thank you very much.
Yeah, thank you very much, Nikki. And, I need to apologize that I didn't, introduce you at first, and
not a worry.
she is completing a PhD at Bond University, and is a risk strategy and a technology consultant of the KPMG. And if you want to know more about her, please look at the app. Thank you very much. And I got 2 questions, and one is easy one is what do you mean by training your model?
Training the model, yes. Okay, so in terms of training the model, essentially we're looking at historical data, which will be, so in the case of the data-driven causal factors analysis, where we had incident information and operational information, we have a series of previous incidents that have occurred, and also we have the operational data which sits alongside those incident occurrences. And when we train the model, we're essentially ingesting all that past data using the modelling technique which we used and parameterising what each of those components in the model should be based on that past experience. So you're essentially creating that structure in the tree and then also the probabilistic parameterisation behind it based on the data that you're using.
Okay, thanks.
And I should add also, the way we did it here was a purely data-driven approach based on the historical information. But there is also the opportunity to overlay an expert judgment element to it. So if you expect that things may diverge from past experience in certain factors or certain types of incidents, you can actually also incorporate that to have a bit of a even further forward-looking based on expert opinion, if you wish.
Okay. Another question is, one of the difficulties with operational risk analysis is consistency of historical data, data captured over time, particularly where risk management frameworks are maturing. How do you suggest tackling this challenge?
Yes, that is a huge challenge. The quality of data and the accessibility of data is, I would argue, and I'll be interested to see the other speakers' perspectives on this, is the biggest hurdle in actually operationalising these type of approaches at the moment. It's somewhat a chicken and an egg problem. What I'm seeing is we need to be able to exemplify what we can do if things are collected in the appropriate way and we're collecting the right information in order to give organisations the business proposition as to why they actually need to uplift their data quality and data collection procedures in their risk function, but also linking that into their operational data feeds. So that element of it is a massive exercise in its own right, and there's a lot of work being done around that data quality uplift across organisations and making sure that we are capturing the timeline of how things are changing over time, because this approach that I've gone through today is a deterministic approach, but we can also move into a time series extension of the model to actually see how these risks and how those operational linkages are changing over time. So capturing the right information and having some consistency over categorisation over time is absolutely key. I hope that.
Yes, thank you. I'm getting lots of questions. So the next one is. Identifying, scoping the risk is the heart of modeling. Any insights on effective identification of operational risk?
So as in the types of risks that we're going to be modelling in the approach?
Not quite sure.
Okay. So in terms of identifying the risks in organisations, so there's a couple of elements we could go here. One is we could use the existing, the risks that have already been identified through the risk and audit committees from a board level when they do strategic risk reviews. The risk functions risk register is having those risks identified, so that can take traditional approach, if you like, how it's done currently in terms of strategic risk workshops and the like. One of the, and if I go back, oh, I think I lost my slides, that's fine. In the overall data-driven ORM framework, the middle module around modelling, I also popped in there risk identification. And so there's been some research done around how we can actually use natural language processing techniques over existing risk registers, either within an organisation, across other risk policy documents, at an industry level, to try and draw out and extract what are those key risks, and then also running that even over things like news articles to identify emerging risks. So you could take a data-driven approach to that identification element as well, which would then feed into your risk systems as to what categorisation of incidents you're going to be using to capture those incident information, which would then feed into other aspects of the modelling modules in the data-driven ORM framework.
Okay. Last question to Nikki. And if you are not satisfied with her answer, or have additional questions, you can have an opportunity to ask a group of speakers later. So please put your questions on the app. The last question from the iPod is, have you considered any approaches to assess the quality of the operational risk reporting to specific teams using analytical methods?
In terms of using analytical method, whoever asked that question, I'd love to chat to you afterwards. But in terms of the reporting of insights from a model to the right people, I think there's a lot of scope that we could really improve that and be smarter in how we're delivering important information in a timely manner to the people on the ground who need it. And I've seen some situations where that's been done in a mining context, where people on the ground are actually getting live alerts based on all of the factors that are being considered in the back end of the model. If they're about to come into a risky situation, they get an alert early so that they can try and remove themselves from that situation, take a different decision, contact people to find out more information. So that idea of changing how risk reporting is going to occur, rather than being a static PowerPoint presentation that a board gets every month to review, I think is going to change the way we do things and hopefully make it better.
Yeah, thank you very much, Nikki, for your presentation.